Hello, this is Rachel Meager, and I'm doing mortgage financing. It's financing for people that need help paying their mortgages for their houses. The current situation of mortgage financing in the US is the largest and most innovative and most complex home financing market in the world. Most of it's governed by federal law because it has a lot of regulations that have tightened since the market collapsed in 2008. The CFPB, Consumer Finance Protection Board, have control over most of the rules for mortgage financing. While home affordability remains a question for many Americans, the downward trend in home ownership also corresponds to banks' tighter credit standards following the Great Recession. Future possibilities are the cost of originating a mortgage is about $9,000 per loan, but throughout time the cost is believed to decrease significantly. Also, we expect to see digital processing used that will decrease the amount of time it takes to request and receive a loan. Currently, people plan on spending weeks and months requesting and being able to receive a loan and going through the process of filling out the paperwork and meeting with people. But in the future, we will see people using digital processing and uploading files to the computer and having documents and having less human interaction. So people could do it by themselves with little help from other people. And it's possible that it'll go down to even just hours of time being spent instead of weeks and months. Also, people will be able to start the process of getting a loan any time of the day. If you're laying in bed at night and you think that you need to work on getting a loan and it's 2 a.m., you can get up and do it on your computer. And then we'll have operators that will help, but mostly robots will be controlling the phones. Other observations that I noticed and read about while I was researching mortgage financing is Ginnie Mae. It guarantees the timely payment of principal and interest payments on residential mortgage-backed security, MBS, instruments to institutional investors worldwide. These securities or pools of mortgage loans are used as collateral for the issuance of securities on Wall Street. And in 2010, there were 3 banks, Wells Fargo, Bank of America, and Chase, and they controlled about 56% of the mortgages. However, in 2017, Wells Fargo, Bank of America, and Chase, and all the banks put together only own up to 40% of the loans, which is a significant decrease since 2010. And that is my presentation. And yes, I see myself playing a role in mortgage financing. My dad has a business that deals with mostly non-QM, which is non-qualified mortgages. He deals with people that don't have the credit to be able to request a loan, so he helps people like that, and that's where 60% of people get their loans nowadays, and 40% are from banks, but 60% of people get them from small business owners or from individuals. And so I could see myself working with those people in the future. Thanks.